What's going on, everyone? This is the Digital World Podcast, making a first video in a long, long time, but I thought it was very, very important here. And I think from now on, when I make videos, I'm going to just hammer the point here on um, homes, right? Because I think we're at a very important tipping point in time, and I'm noticing this more and more and more. So, a lot of people don't know, but the 30-year treasury yields tend to go along with the mortgage rates for home. They're not 1 to 1, but whenever you see the 30-year yield spike, you're gonna see the mortgage rates go up. And as of yesterday or today, we're seeing these 30-year mortgage rates spike up to about 7%. Right, the yield is around, like, I believe, around the 5%. And so this is very important to keep note of. Usually, as you see these yields spike higher, right, it becomes more burdensome to be able to get a home. But also, what you see is typically the actual price or value of the home start coming down. Some of the real estate agents, and I'm not speaking for all, but there's a good majority that'll tell their clients, hey, you better get in on a house right now because come summer, everyone's going to want to be buying. Mortgage rates are going up. You better take your chance. And those same people are getting, for better or worse, they're getting their clients into a sticky situation. And I don't think people understand what they're getting themselves into. And they're just to be able to get into a house, right? And so here I ask Grok a few questions, right? The correlation between mortgage rates. And obviously, like I said, they're not 1 to 1, but if you see these 30-year yields spike up, that's a good indication that your mortgage rate is going to go up, right? And so here you can see, however, mortgage rates are typically higher due to a risk premium, reflecting the additional risks of mortgage, right? So historically, mortgage rates generally move in the same direction as the 30-year yield, driven by shared influences like inflation expectations, economic growth, Federal Reserve policy, etc. From the Fed, which is the Federal Reserve Bank of St. Louis, shows that over time the two rates exhibit a strong positive correlation, which means they're like, if one is moving up to the right, like going higher over time, that's what it means, positive correlation. They share that type of correlation, I guess, for lack of better words. Though the exact correlation coefficient varies depending on the period analyzed. For example, from 1990 to 2020, the correlation between the 30-year treasury yield and 30-year mortgage was often above 8, indicating a strong relationship. So if they were to be perfectly similar, it would be a 1. So by it being 0.8, that means it's very strongly correlated to each other. Okay? So the spread dynamics, factors influencing the spread. So I think these are important points to look over. Prepayment risk. Mortgages can be prepaid early, which affects the effective duration, right? So we know that, like, the more you pay into the loan, the faster it won't be 30 years, right? It actually speeds up, which in fact, if you kind of do the calculations, depending on what the mortgage rate on your home is, you end up paying double what the actual value of the house is when you first sign. So it's that interest rate really matters, because it can determine how much you pay in interest over the course of 30 years. Credit risks. Mortgage can carry a risk of default, requiring a higher yield to attract investors compared to treasuries. Yield curve. Let's see. Market conditions. During quantitative easing, the Federal Reserve's purchase of mortgage-backed securities narrowed the spread, pushing mortgage rates lower. Conversely, during quantitative tightening starting in 2022, the spread widened as the Fed reduced its mortgage-backed securities holdings. So that's kind of what we're seeing here. It says, as of April 2025, the 30-year mortgage rate was reported at 6.83, while the 10-year was at 4.33. However, direct data on the 30-year treasury yield is less frequently referenced in recent sources due to intermittent issuance. Still, mortgage rates have been more closely tied to the 10-year treasury yield in practice, as the average mortgage duration is closer to 7 to 10 years. So just right now, like I said, what's important to note here is the correlation coefficient, which is zero point 0.8, which, like I said, 1 means they're perfectly similar. Zero point 0.8 indicates they're very strongly correlated. So over time, as the treasury yields are going up, it's also correlating with mortgage rates going up. And if you look in the um, housing market, what you're going to notice is, and it's crazy because yesterday I was looking, in the Pacific Northwest, and I was looking at different homes, right? Browsing through Zillow. And I look and I'm like, oh, okay, you always keep an eye on certain properties where you're like, yeah, this would be good at not at that price range, but given that an opportunity comes around, right? Or what you see down the line, you're like, oh, I'll keep this in mind. Yesterday, if you look at the yields, they spiked, they went up, and as those go up, that often correlates, like I said, with mortgage rates, especially if you're looking at the 30-year yield. And what do you know? Some of the properties that I had my eye on, just to keep tabs on, those were all pending today. And so I know yesterday, there was a lot of talk about mortgage rates are going to be going up. I read like a figure that's at 6.99, 7 point something. So it's hovering about around that 7% range. And so if real estate agents are telling their clients, hey, it's that time of year, the seasonal time where you see a lot of people ramp up buying, start getting into the market, and also mortgage rates are going up. I know that messaging, and I've heard it multiple times from multiple real estate agents. They try to get their clients to get in, buy before they say, hey, you're not going to get the house you want. It's going to get more expensive. And these very same people, right, that are going in and buying these houses because they don't want to miss out, right, are the ones that end up losing these houses. And it's an unfortunate situation, right? If everyone was well studied and well versed, they would know that there's cycles to this thing, right? Over the course of time, right, it goes up, and that's a different point of conversation relating to Cantillon's essay, which is a very, very interesting study in economics. So just thought I'd present this. This is something we're really going to be harping on, and I'll be making more videos on this topic. So thank you for watching. This is the Digital World Podcast. I'll see you in the next episode.